Tēnā koutou katoa. First, very much as widely anticipated, we have left the official cash rate on hold at 1.75%. Also, as largely anticipated, we expect to keep it low, but for longer. So that is really, I would say, the information space that we provide you today. We also believe that the next move for the OCR could be either up or down, but we see the risks very much as balanced, and we can talk about those risks today. Recent economic growth has moderated. We were trucking along above 4% per annum in 2016. The most recent print has us below 3% at 2.7% growth. So that moderation has meant that there is more room for monetary stimulus for longer, and that is what we are providing. Looking ahead, we do anticipate economic growth to pick up. There are many reasons for this, for the environment to be conducive to stronger economic growth. The first, of course, is world economic activity remains robust. World economic growth is well north of 3% per annum, and it has very strong momentum on the way through. Of course, that world growth is mixed depending where you are. US economic growth, very strong. Europe growth is picking up, and Chinese economic growth has showed signs of stimulus coming back through. Another big area of excitement for us, of course, is the New Zealand dollar exchange rate has been lower. So we do see our net export earnings being stronger and profitability in that sector coming back. The government is also implementing a significant spend and investment program over the next 3 years, and that will have a significant command on our economic resources, both capital and people. And likewise, of course, this is sitting on top of a bed of what I would say is reasonably robust residential construction growth, given the housing needs, and ongoing household spending. Although nominal wages have been low, they have been rising faster than inflation, so there is money in the pockets there. Through this growth pickup that we anticipate, we expect employment to remain strong. We do see ourselves as being broadly near this concept of maximum sustainable employment. So really new demand for labour is being met with labour supply. We do see unemployment easing, declining, I should say, from here to around the low 4% over the forecast period. Of course, there are many, many uncertainties around what is a maximum sustainable employment level, and we are operating primarily in the cyclical demand side of things. We forecast inflation to continue to pick up from where it is and to be at the midpoint of our 1 to 3% inflation band over the forecast period. I'd have to say we have been positively surprised with some tentative signs of core inflation picking up. We've sat here many times with forecasts of inflation going back to the midpoint. We have been continuously surprised by how low world tradable prices have been, i.e. our import prices, and also how muted, probably at least forward, if not a little bit backward-looking inflation expectations from the public, holding down our overall inflation. But times are changing. We are seeing global inflation pressures starting to rise, so that downward pressure from import prices is waning, and we will see our tradables, our domestic inflation, remaining around that 2.5 to 3% rate over the forecasts. There will be some bumps along the road, of course, on the inflation path at least. There are some one-off price increases that we're well aware of arising. One, of course, is from the lower exchange rate and hence import prices. We've had higher world oil prices that we expect to remain at relatively elevated levels in the forecast. And there are the petrol excise tax plans being implemented over the next, in stages over the next couple of years as per our forecasts. These are all one-off price bumps. We intend to look through those. We intend to remain vigilant looking for, I would say, inflation momentum and rising inflation expectations before we react to that. What are the risks? Well, as I mentioned before, we believe they are balanced, hence the up or down next move on the OCR. It's interesting given that we are in a low and stimulatory position at the starting point. That gives us comfort given where actual inflation is relative to target. In terms of upside risk to the official cash rate, inflation and inflation expectations could get away quicker than what we project. The challenge there, we are seeing margin pressures in businesses that could be passed on into higher prices where they are able to, and the higher prices could lead to higher inflation expectations and wage demand and so on than what we have in our forecasts. Likewise, on the downside, we're well aware of business confidence levels being low. As we've talked about in our document, we spend more time focusing on what I would say firms' own activity and investment intentions. They've also declined somewhat over recent periods. Hence, we do have a more muted investment cycle projected, but our growth could take longer to pick up than what we project through that side. So we're comfortable where we are. We will do what central banks do best, which is watch, worry and wait. And in the meantime, the OCR remains where it is. We set our monetary policy based on what we observe and what a government's intentions are. And so really the official cash rate setting is based on how we see the economy evolving, and part of that evolution is government's investment intentions. So it's having taken on board that behaviour. So that's right. I would want to emphasise that the government investment is one part of the equation, and it's a big known part in the extent that it is completely endogenous within their control to do this work. The risks we put around it is can they spend as quickly as anticipated? Will we see as much stimulus as what's in there? But I do want to emphasise that part of the growth story is very much about a transition around net export growth being much stronger, given where the terms of trade are, given where the exchange rate level is, and given where world growth is holding up. So that is a net export, a transitional change for the growth drivers of New Zealand. Likewise for business investment, you know, the great unknown, business investment, given the capacity constraints that are out there in the economy, given the tightness in the labour market, and given that global demand, all signals are green for business investment. But there is uncertainty in businesses' minds at the moment, and we're cognizant of that. Hence, we have kind of tempered, I would say, our growth for investment. We target a range between 1% to 3%. Of course, you aim for 2 because that makes sense. If it's, you know, it's no different if you were playing darts. If you're trying to hit the board, you'd probably best to aim for the middle. But you know, it's the full range that we are targeting, and there will be noise coming through this. I don't want people to be spooked by that noise, by one-off price rises or, you know, near-term shocks. We have been most surprised by how low and stable global inflation and domestic inflation and inflation expectations have been.